Good morning, everybody. This is the live market open for December 2nd. It's Wednesday. Yeah, as you said here in the comments, we have a packed agenda, stacked docket. Sorry for the delay in the opening. I'm Yohay Elam of Forex Crunch and Market Movers podcast, doing the show as every morning for FX Street. As usual, we'll talk about recent developments, follow some charts and levels, discuss the next 24 hours, which are very busy, and answer your questions. If you can't see the chat box, please go to tlk.io/fxstreet-forex-live-video. I see quite a few of you are already in the room. So let's start with what we had yesterday. We had great news from the Eurozone regarding unemployment. Unemployment in Germany, that dropped by 13,000 people, less unemployed, and the unemployment rate fell by to 6.3%. Both figures better than expected. In the Eurozone, the wider Eurozone, unemployment rate fell to 10.7% from 10.8%, also better than expected. So we would expect the euro to rise. We did see that, but we mentioned yesterday at the 106.30 level, we had the pair rising from support here at 105.60 all the way to 106.30, a bit above, but then falling back down. This morning we're seeing it rise once again to 106.30. Let's see if it if this really holds on, okay? But we've seen it bounce along this range and then not really breaking above, making a false break if you wish, or just looking above, falling back down into range and now trying to rise once again. Good news from the Eurozone all around, okay? It adds on to good manufacturing PMIs we had beforehand and more stuff like that. In the UK, we had a miss. Manufacturing PMI, which was excellent last time, dropped to 52.7 points, worse than expected. This did sort of ruin the party for the pound that was recovering after escaping this 150 level. But all in all, it's keeping a safe distance. Currently 150.80, support 150.60, resistance 151.15. We had also here this peak above this level. I don't see it as a real break. Anyway, the pound is a bit weaker, but still looking relatively good. We had yesterday GDP in Canada falling 0.5% month over month, worse than expected. Okay, so Canada is officially out of the recession. The economy squeezed for 2 consecutive quarters, Q1 and Q2. And then Q3, it's out of the recession, but the month over month fall of 0.5 was quite disappointing. So, contrary to other pairs that gained against currencies that gained against the US dollar, this pair was a bit more stuck. 133.70 is a battle line, resistance at 134.60, support at 132.80. Okay, and I mentioned that the US dollar dropped yesterday. One of the reasons was ISM manufacturing PMI. It fell into contraction ground, under 50 points in the manufacturing sector. Small sector in the United States, not as big as the services one, but we don't want to see any signs, any fear of recession, even if it's one sector, okay? So this was a disappointment. It was the worst in 6 years, if I'm not mistaken. This negative number here, under 50, was bad. But as I mentioned yesterday, there was something else to look at. It was the employment component, and this came out at above 50 points, better than last month, which is a good sign for the non-farm payrolls. So there was this kind of silver lining. All in all, the dollar yesterday was on the defensive. So we saw that more in the euro, for instance, where we had better than expected figures, and less in the pound and the Canadian dollar. But we've seen the dollar on the defensive, but not fall too much. Okay, and New Zealand milk prices rose by 3.6%, better than after 3 consecutive falls, and this enabled the kiwi to move even higher, consolidate its gains. We've seen it break above 66 earlier this week, yesterday. Now it's approaching 67 at 66.70. But that's not the end of the news we had yesterday. We had 2 members of the Fed speaking. One of them, Charlie Evans of the Chicago Fed, he repeated what he said in previous times, that he while he's relatively dovish, he prefers a gradual approach in the future, but basically he's accepting a rate hike. He's resigned. He's sort of going with the flow. On the other hand, another dove, Lyle Brainerd, she spoke later in the night, and she had a very clear message. She does not want a rate hike now, and she wants the rates to remain low. She's a voting member. Let's see if she votes against the rate hike on December 16th. We're only 2 weeks from the big event. Okay, so she is a dove that remains a dove, not accepting, not making compromises so far. And Australian GDP beat expectations with 0.9% quarter over quarter. It wasn't totally unexpected because we had some hints it would be better. But anyway, the Australian dollar is holding onto the gains. Yesterday it made the break. You talked about this level is 72.80. So we had initially yesterday we had it bounce back down and then made a breakout, and the high so far is 73.42. We're a bit lower now, but the Australian economy looks better. The RBA is relatively upbeat on the economy. Of course, it doesn't want a strong Australian dollar, but so far so good. We heard it yesterday once again from Glenn Stevens, the governor of the RBA. In general, he said that the swings in the Australian dollar, either up or down, help the economy. So when we had boom in the economy, when we had commodity prices high, we had also a strong Australian dollar, and that limited inflation. And now that we have crashing commodity prices, copper, iron, things like that, we have a weak Australian dollar, and that supports the economy. So he doesn't seem too eager to act anytime soon. In any case, the next RBA decision is only in February. So I think, yeah, we didn't cover the yen. Yen is a bit higher within the range. Sorry, dollar yen. That's sort of against the trend of a weaker dollar, but not really something huge. So you could say it's a risk-on atmosphere, no desire for safe haven yens, but the range is quite limited, 122.75 to 123.20, currently somewhere in the middle. The bigger range is 122.20 to 123.60. Okay, dollar Swiss falling from the highs because of a weaker US dollar mostly, finding some support here above 102.30, currently 102.55, resistance at 103.30. Yeah. Euro Swiss 109, just around 109. Remember, the Swiss National Bank is on alert to weaken the Swiss franc in the wake of Draghi's big event tomorrow. Okay. Euro pound broke above this range line. Well, still battling it, but 70.50 at the moment. Next resistance at 70.80, support at 69.80. Euro yen, well, weaker yen, stronger euro. We're seeing it also here. 130.80 and 131.50 is the line I see as resistance. Support at 129.70. Okay, and pound yen, one of your favorites, currently well within range, quite a well-defined range between 186 and 184.30. It's well within this range. 183.80 on the downside and 188.10 on the top side. Okay, that's what we had so far in the review of the charts. Any questions? In any case, let's talk about the big events for today, and they are quite big. First of all, we already had Spanish unemployment change. It came out better than expected. The number of unemployed in Spain dropped by 27,000, which is good news, especially good news for the government because we have elections here in just 18 days on December 20th. Sorry. So this is also perhaps one of the figures supporting a stronger euro this morning. But yeah, you can see I just talked about the euro strengthening this morning, and it failed to really break above 106.30. The high so far 106.36. Okay, still not going anywhere fast. Okay, that's just a warm-up. At 9:30 we have construction PMI, the second out of 3 Purchasing managers indices in the United Kingdom. So yesterday we had a disappointing manufacturing sector read, which is basically back to normal for the UK and for other developed countries. Manufacturing is not that strong. Today, construction was always the leading sector in the recovery in the United Kingdom. The figure is expected to drop from 58.8 to 58.2. This still reflects very, very strong growth in the construction sector. 50 points separate contraction and growth. All right, at 10 GMT, just half an hour later, we have the last big hint, if you wish, towards the ECB decision tomorrow. Okay, so let's talk a bit about that. We have inflation numbers from the Eurozone. We're expecting, and we should look more at the year-over-year figures and not the month-over-month. Okay, so the year-over-year headline inflation, which is the mandate of the ECB, this is expected to tick up from 0.1 to 0.2%, still under the influence of oil prices, the collapse of oil prices that began late last year and continued. We remain at low oil prices. So this is the mandate of the ECB. The ECB needs 2% or a bit below. Okay, and then core inflation is also important. Even though it's not the mandate, Draghi looks at that, recently said that the strengthening of core inflation is weakening, okay, that it's losing momentum. Expectations are indeed for a loss of momentum, for a drop from 1.1 to 1% year over year. Let's see if that really happens, or we'll have another upside surprise for the euro. Now, the big question for Draghi is, and the ECB in general, is do these figures matter? Okay, in theory, yes, they still matter because that's the mandate of the European Central Bank. Okay, so if the figures are better, maybe there's no need to act, or maybe act just a bit, or maybe just talk about action. Okay, because if inflation is picking up, if unemployment is falling, if forward-looking indicators like purchasing managers indices are on the move, everything is looking better, everything is improving, why would you want to act? So first of all, and my answer to that is, first of all, they're committed now, okay? Use the word vigilance, and he talked about it again and again and again. So one figure, two figures, even 5 figures this week will probably not move the ECB. Secondly, Draghi has more influence, more support on the ECB and the governing council than he had, let's say, a year ago. Okay, the Germans are in opposition. They're in a minority over there. Thirdly, one of the reasons for this success is what Draghi did so far, is weakening the euro. Okay, that's the best transmission mechanism. When you hear these words tomorrow, transmission mechanism, it means more how the ECB supports the economy by providing more liquidity, lower interest rates, more inflation, things like that. But the best transmission mechanism, if you wish, is that the euro is weaker. That means exports are more attractive, and inflation, imported inflation coming from outside, is higher. Now, if after everything he said, he will not act tomorrow, the ECB will not act and or do very little, then this achievement could be reversed. Euro dollar could bounce back up, and the euro. This means also a stronger euro against the Chinese yuan, and Germany depends a lot on exports to China, so it won't be so positive. You would like to maintain the situation, or even have a weaker euro. And now this brings another question: what is already priced in? We've seen, okay, today we're seeing a small rise. Yesterday, 106.30, nice. But all in all, in the past, we've been around 115 just 6 weeks ago. Okay, so maybe everything is already priced in. I believe that more QE is priced in, but a big cut in the negative deposit rate is not. Okay, we'll do a larger preview tomorrow, but these are two things to watch. The third thing is forward guidance. If he says, okay, this is what we did now, but we're ready to do more in January, March, April, the next meetings of the ECB, it's of course more meaningful than, okay, this is what we've done and that's it. All right. But anyway, I believe it's not priced in. I believe that the ECB has a chance to have a bigger negative impact on euro-dollar than the Federal Reserve. Okay, so we did a sidestep to inflation and the ECB, and that's only the beginning of the events for today. Then we have at 1 and 10 minutes Dennis Lockhart of the Fed, speaking about monetary policy. He's relatively leaning to the hawkish side. Let's see if he's more supportive of a rate hike or just speaking in general terms. ADP non-farm payrolls at 1:15 GMT. This is a significant hint towards the non-farm payrolls on Friday, the official government one. So we're expecting here a small improvement, a gain of 190,000 jobs in November instead of 182. This is only private sector. The correlation is not always full, but undoubtedly this moves markets, okay? Then 15 minutes later, we have a speech from Janet Yellen, the chair of the Federal Reserve. But these are only opening remarks for some event in Washington, okay? So I think it'll be a non-event, this specific public appearance at 1:30 GMT. Later on, let's put it here in bold at, I think I have the wrong hour here, just let me check that. But her second appearance, no, I have the right hour, yeah, 5:25 GMT. Yellen provides a full speech, okay, and this in this occasion we could have hints about her testimony tomorrow, about the non-farm payrolls, and of course, most importantly, about the rate hike and the future rate hikes. In general, the line from the Fed is we want to raise rates in December. We're on course to raise rates, and afterwards, rate rises will be very, very gradual. She might also not say anything. I believe she will say something. Let's see how markets analyze this. Basically, if we look at this implied probability for rate hike from yesterday, let's refresh it. We had a small drop in rate hike expectations to 75%. It was 77%, but and it's important to remember that this is the implied probability for rate hike to 50 basis points, and because the Fed has a range of currently 0 to 25 and later 25 to 50, that means for a rise to 37, which is in the middle, 37 basis points, this implies more or less 100% according to bond markets. So let's see how expectations shift after her words. I see questions here. I'll finish the events for today and I'll reach the questions. And so I just talked about Yellen. I skipped the other figures. At 1:30 GMT, we also have, during Yellen's first appearance, which is only opening remarks, we have revised unit labor costs. In the United States, second-tier figure, but worth watching if we have a bigger surprise over there. Let's see what's on the expectations. Revision from 1.4 to 1.1 to the downside. Anyway, also productivity is released at the same time. I don't think it'll have a big impact. At 3 GMT, we have the decision from the Bank of Canada. Let's see how they talk about the recent employment figures, which were positive, and Friday's figures, and also about the GDP figures yesterday. No changes expected in policy. But anything they say, if they're more upbeat about inflation, it'll be positive for the Canadian dollar, and they have reasons to be more upbeat. Employment also looks good. Canada is out of this shallow recession. On the other hand, oil prices are depressed, and this weighs, of course, on the Canadian dollar. I expect them to be relatively positive, but let's see that at 3 GMT. I've talked about Yellen. Later we have at 8:40 GMT, we have John Williams of the San Francisco Fed. I would say he's a centrist. He's also talking to provide more hints. At midnight GMT, Australian trade balance, and 1:45 the Caixin services PMI of China not manufacturing, but still can move the Australian dollar. So that's a very, very packed agenda. We have once again this morning. Let's go back this morning. Construction PMI, inflation in the Eurozone, speeches from Fed officials, most importantly Yellen, ADP and FP, a huge hint for the non-farm payrolls, rate decision in Canada, you name it. Okay, so we have a question here from Alexei. Good morning. I think that the rate hike should favor the global economy as a whole. Pushing the dollar higher will favor a tightening between the different big world economies because it will favor the European exports since the US will start to import more due to weaker euro. So I think that the short term, it's good to see a stronger dollar. Correct me if I'm wrong. Thanks in advance. So I see a rate hike starting gradually as the majority of Fed members are pointing out. Yeah, certainly agree, Alexei. The United States economy is the largest economy in the world, and more importantly, it's the leader. It sort of moves first, so it's supposed to pull the world forward, and it helps the world collapse as well. The United States is in many cases first in good things and bad things. And the United States economy is also a bit more closed economy. It relies less on exports and more on internal consumption. So it can suffer, it can maintain a stronger dollar for longer, while the Eurozone depends more on exports. So if the United States takes this reign from a stronger dollar, it might see a rainbow. It might see it as an investment to help the Eurozone economy and other economies in the world take advantage of the strong dollar grow, and this will eventually, in theory, turn into a virtuous cycle instead of a vicious cycle that we had so many times in the past. So yeah, the Fed gave us big hints in October and then explained it in the Fed minutes, and we had a strong NFP. Everything is leading to a rate hike. How much is it priced in? I would say mostly. But it's still a historic event. It can still strengthen the dollar when it happens. Okay, 2 weeks from now. And then, of course, they mentioned it many, many times, and the market is only now beginning to think about the fact that what the Fed is telling us all the time, that rate hikes will be very, very gradual. Okay, so yeah, that's the sort of the main line. I see another comment from you. So I do not see why many people are concerned about the falling of the euro, mainly due to the possible more easing and rate cut in deposit short term. Actually, it favored the Europe economy, maybe starting middle of 2016, around Q2, correct? Yeah, I agree also with that. First of all, we're already seeing improvement in the Eurozone economies thanks to the weaker euro. We're seeing unemployment falling. It's a long process. It takes time. There's a delay between the moves and the actual changes in the economy, but we are seeing things improving. So if euro dollar remains low and euro remains low against other currencies for a bit longer, yeah, perhaps the second quarter of 2016, we could see an even bigger improvement all around. Yeah, but in order to do that, I think the ECB needs to keep on pushing forward and not letting go. Okay. More questions? Of course, other reforms are needed. More integration. It's not only currencies that move economies. All right. Any more questions? Maybe we'll do a recap of what we had so far this week and mention the next events tomorrow and Friday. I see quite a few of you in the room, in the chat room. Anyway, we're seeing euro dollar hesitate around this level of 106.30, which was support last week. All right, so recap. On Monday, we had German inflation coming out as expected, bang on expectations. Yesterday, we had Chinese PMI a bit better than expected, and the RBA statement quite positive. This supported the Australian dollar. Mark Carney of the Bank of England spoke yesterday. He didn't say anything new. It was related to stress tests. We had Canadian GDP coming out worse than expected. It sort of depressed the Canadian dollar. ISM manufacturing PMI yesterday showed contraction, showed that the manufacturing sector is squeezing. Bad news, but the employment component was positive, came out at expansion at 51.3 points, if I'm not mistaken, so it was a good figure as well. Today, we talked about the events for today. They're really huge. Australian GDP better than expected. Eurozone CPI, last big event before the ECB. ADP, NFP, a big hint for the non-farm payrolls, not the last one. Yellen talking. Remember, Elam talks also tomorrow, and tomorrow it's an official testimony. Rate decision in Canada. Yeah, and tomorrow's, I think, the biggest day because it's the ECB decision. And Yellen's testimony, ISM non-manufacturing PMI, the services sector in the United States, a more significant hint towards Friday. And Friday we have, of course, the non-farm payrolls and also Canada's job report. So it's one of the busiest weeks of the year. Always the first week of the month is always busy, but this time it's with the ECB decision, Yellen's testimony, which don't happen every beginning of the month. Okay. Talked about Canada, I talked about oil prices, but we also have the OPEC meeting on Friday. No changes expected. OPEC members are not really able to agree with one another on policy. We've seen it last year that Saudi Arabia pushed for not cutting production, for pumping more and more oil, and because they wanted to maintain market share, and they angered other countries. In addition, OPEC's share in the global oil production is more or less a third, if I'm not mistaken. They have less impact. If you want lower production, you would need to coordinate with the United States shale industry, the Russian oil industry, Norway, Canada, Mexico, many non-OPEC countries. Anyway, oil prices have stabilized a bit, 41.60, 42.70, and 43.40 are resistance lines. Support is at the round number of 40. We've seen it here as triple bottom. And the low of the year was just under $38. And this crashed in August. Yeah, right here, 37.73. Yeah, so production of oil is falling in the world. At least investment for the future is falling. Eventually, prices could balance out, but to see some more immediate reaction, in the shorter term, we would need an immediate cut of production. Currently, there's just too much oil running around. One event I didn't mention is that today we also have the weekly inventories data. Official expectations here are a fall of inventories of oil, but as we've seen so many times in the past, inventories have risen, and there's just too much oil running around. And this is, of course, negative for oil prices, negative also for the Canadian dollar. Okay. Euro dollar daily chart, currently 106.23, 106.30 is resistance, 107.10, 108.30. On the downside, we have the cycle low so far of 105.60, but then very close, we have the April low of 105.30, and then the 12-year low of 104.60. That's critical line. Let's see if Draghi, if he brings a big surprise, if he can send euro dollar below this line. But remember, we have differing opinions in markets. Many say that ECB action is already priced in. The ECB can disappoint. It'll be a buy the rumor, sell the fact. I don't think so. We'll learn tomorrow. Okay. Another question from Alexei. What can be the effect of the euro dollar in case of a dovish talking by the ECB? I mean, how can we expect the market movement regarding euro dollar? If now a new comes out, already talked period again. No news. Well, if we don't have news from the ECB, if we have just no cut in the deposit rate, or only a small cut, if we have only small enlargement of QE or no enlargement, if we have only an extension of QE beyond September 2016, which is something that is fully priced in. Anyway, something that doesn't meet expectations, I believe we'll have euro dollar shooting higher. 107.10, 108.30 are the levels to watch. There are quite a few analysts and quite a few banks that expect this to happen. I buy the rumor, sell the fact. My experience with Draghi, my analysis, I may be right, I may be wrong, is that he tends to under-promise and over-deliver. Okay, so if you already asked about what's expected in terms of numbers, that's not what you asked, but let's say what a disappointment or surprise can be. So the latest we had from the ECB coming last week, we had Reuters report rumors talking about a two-tiered negative deposit rate. It's something that the Swiss did and the Danes did. Switzerland and Denmark have much deeper interest rates, 0.75, but it's more on the wholesale level. It's more on loans to companies, less to depositors, okay? Because if we have, if you want to keep your money at the bank, and the bank tells you, okay, if you leave 100 euros here, 1,000 euros, let's say, next year you'll pay us 7 euros for keeping this money, or something like that, you'll maybe consider keeping the money under the mattress, okay? It depends how low it'll go. But if another institution is punished this way, this might invest it. Okay, so that's one rumor. That would sort of make a cut in the deposit rate more manageable, for more complicated, but more not hurting the little people and not hurting savings too much. Another option is expanding the basket of QE, buying also municipal bonds, corporate bonds, and things like that. Now, Reuters also had another thing. They had a poll of economists, and I believe that this reflects expectations. They're talking about negative deposit rate currently at minus 0.20. They want to see it falling to minus 0.30, just 10 basis points. I must say I've read some that think it will not be cut, and some think it will be cut by 20 basis points to 40, minus 40. I think Draghi can even surprise with minus 50. And QE, the amount of monthly buys, it's currently 60 billion a month, and we're expecting, according to this poll, 75 billion, 25% increase. I believe this is more realistic. QE has more political obstacles, and the ECB has less stuff to buy. Many European government bonds are have negative yields, but yet again, it'll be easier to buy more bonds if the negative deposit rate is lower. Why? Because the minimum yield that the ECB buys bonds at is the negative deposit rate, minus 0.20 currently. So if it cuts it deeply, it can buy a whole range of new German bonds and, of course, other bonds in the Eurozone. It can also increase QE. Okay, other question from JM. In terms of NFP employment figures, what would be a disappointing figure? So the Fed would consider a no hike. Would you say less than 180,000? I know consensus is about 200, but 180 is a decent figure. Well, first of all, let's look at the expectations. All right. So where is that figure? Yeah, expectations stand on 200,000. This might be indeed a bit optimistic. Yeah, yes, last time we had 271. That was a blockbuster. That could be a one-off. 180,000 can certainly be realistic. I believe it will not put off the Fed. The Fed is determined to raise rates. Yes, it is data dependent, but no, one figure cannot make the difference. Okay. So it'll need to be really, really bad. I think under 100,000 for the Fed to consider delaying a rate hike. Expectations are very high. We would need a really disaster figure. Disaster means not only weak NFP, weak headline, we would need a downwards revision, a rise in the unemployment rate, fall in wages. And wages, this is an important figure. Look at this chart here. Let me zoom out of the pre-crisis era. Okay, this is the last 5 years or so. You see the annual rise in wages is limited between 1.7 here and 2.3, and it was stuck in range. Last time it broke out of range, the highest since 2009, right? Since this year-over-year rise, 2.5% year-over-year, okay? Also, this may be a one-off, like the headline jump, but if wages are okay, I would say 2.2 is, or 2% is good enough, and jobs rise above 100,000, it'll be good enough for the Fed to raise rates. Only a disaster, I think, can prevent a rate hike at this point. Well, of course, unless we hear something totally different from Janet Yellen today and tomorrow, but in general, that's the trend. That's what the Fed has been telling us. The Fed has been making all the possible preparations to tell us that rates are rising. Okay. Oh, thank you very much for your kind words, Alexei. Completely agree. Thumbs up. Thank you very much. Well, welcome. I'm glad I can help, and I hope I'm not wrong on too many things. Anyway, these are my explanations. Any more questions? We'll get to the wrap up for the day. Yeah, euro dollar is still under 106.30, not moving anywhere fast. Looking forward to those the inflation figures from the Eurozone. Okay. All right. Let's begin the wrap. This is the wrap up for the live market open. It's Wednesday, December 2nd. We had lots of events and we have lots more today. German unemployment data beat expectations, and so did Eurozone unemployment figures. Good news from the Eurozone, not for the first time this week. The question is it enough to stop Draghi? Probably not. But today we have the inflation figures, which are, of course, the ECB's single mandate headline inflation. And this is the key event for the euro to watch. Probably not change the ECB's mind, but it can certainly impact the euro. Okay. UK manufacturing yesterday missed and kept the pound a bit depressed. Canadian GDP missed as well, fell by 0.5 month over month. Canada is officially out of the recession, but still looking for a direction. The kiwi dollar extended its gains thanks to milk prices rising by 3.6% after 3 consecutive falls. Yesterday, we had bad figures from the United States. In general, forward-looking ISM manufacturing PMI showed contraction, shrinkage in the manufacturing sector in the United States, but we had a silver lining. Employment is growing in this sector. Shallow growth, but it's positive. It's a positive hint for the non-farm payrolls. We also had 2 doves talking yesterday from the Fed. But there was a difference. Charlie Evans of the Chicago Fed was dovish, but accepted rate hike, while Lyle Brainard of the board, she was making her arguments against rate hike, very, very dovish. Okay, Australian GDP beat expectations with 0.9%, and that helped the Australian dollar maintain the break above resistance. Okay, today we had already Spanish unemployment change coming out better than expected, continuing the winning streak of Eurozone figures this week. UK construction PMI at 930 always shakes the pound, always lots of action around that. It's the best sector in the UK. Eurozone inflation, as mentioned, we're expecting 0.2 in the headline number and 1% in core inflation. Every tick up or down will rock the boat. In the beginning of the US morning, we have Dennis Lockhart, a relative hawk, talking. ADP non-farm payrolls, key release for the NFP on Friday. Expected there around 190,000. Above 200,000 would be good for the US dollar, and a miss would be negative. It isn't always well correlated, but it always moves markets. First public appearance by Elam today at 1:30 GMT. Not expected to say anything because these are only opening remarks, but she speaks later at 5:25, a full speech, and this could be meaningful. She speaks also tomorrow in an official testimony, so maybe she'll keep the best for last, but I believe she will move markets. We also have the revised unit labor costs in the United States, and we have a rate decision from Canada. No changes expected in the interest rate, 0.5%. The tone of the statement is expected, always, of course, move the Canadian dollar. Figures have been relatively positive in Canada lately, employment, inflation. On the other hand, we had oil prices still depressed, and this impacts the whole economy. Okay, another Fed member, John Williams, a centrist from the San Francisco Fed, speaks at 8:40. And during the night, we have Australian trade balance and Chinese services PMI. Less important than manufacturing in China, but still rocks the boat for the Australian dollar. Let's look at the charts. Euro dollar, despite all the good news from the Eurozone and some bad news from the US, it did recover in the range 105.60 to 106.30, but seems unable to break higher. Okay, further resistance 107.10, 108.30, and downside 105.60, 105.30, and 104.60, the 12-year low. Pound dollar is now sliding just a bit ahead of the construction PMI, 150.67, support at around these levels, 105, 150.60, further support at 150, resistance 151.15 and 152. Dollar yen rising in range. We're seeing some strengthening of the US dollar this morning. 123.20 is weak resistance, stronger resistance at 123.60, support 122.80, and stronger support double bottom at 122.20. Canadian dollar awaiting the rate decision around this battle line of 133.70, resistance 134.60, and support 132.80, 132.40. Aussie dollar made a nice break after a struggle above 72.80, next resistance 73.60, but it seems to be a bit hesitating. Further resistance 74.75, support 72.20 and 71.50. And the Kiwi dollar maintains its gains, 66.64, resistance at 67, support at 66, and then 65.50 and 65. Okay, these are the main currencies, main events. Very, very, very busy day. It's going to get even busier tomorrow. We'll do a larger preview of the ECB decision tomorrow, and we'll analyze everything that will happen today, and it's very, very busy. Stay tuned. Forex Crunch and FX Trade for all the updates. Okay, and now before we head off, I see here a question. Thanks for posting the chart. I'll open the chart and share it with everybody. Oh, why can't I share it with Oh, okay. So here goes. This is the chart from Sinatra. Okay, I see it's a chart of euro dollar. Yeah, 106.30. Yeah, 106 is a round number, and then see that you put here 105.70, and you put some trend lines as well. What do you have a specific question about this chart? You have converging. Oh, I see the convergence here at 106. Yeah, more or less the lines I also look at, but in general, the trend in euro dollar remains to the downside in the longer term. But Forex trading is never a one-way street, especially now that we have all this tension towards all the big events. Okay, so thanks for the chart. Any specific question about it? There's no HT. Anyway, okay. That's it for today. Thank you very much, everybody, for coming along, for the questions. As usual, we'll be here tomorrow. Sorry again for the small delay at the beginning. Anyway, thanks, everybody. Wish everybody success and safe trading day. And also, yeah, and see you all tomorrow. Thank you and bye bye.